my goodness. I'd like to, it is 10 o'clock, and I'd like to go ahead and call to order the City Employee Pension Fund Board regular meeting of July 30th, 2024. And welcome, everyone. And the first item of business is our minutes from June 11th, 2024. And I'll entertain a motion. If you'll turn your microphone on, we need your face and your voice. Your microphone on to make a motion, please.
I'll move to approve the minutes.
Thank you, Councilmember Baxter. And is there a second?
Second.
Thank you, Director George. Now, are there questions? Are there corrections, additions, anything we need to change about the minutes? All right. Now, for voting purposes, we'll say aye and also raise our hand if you all can do that. So all those in favor say aye. Aye. Okay. Is anybody opposed? All right, that motion passes. We have for our information only the fourth quarter expenses, which are on page 3. If you'll take a look, and this is for your information, report of what's gone out. And the next thing we need to do is ratify the estimated payroll for July through September, and that is on page 4. Did anybody have we'll require a motion for this, and then we'll have questions about it. Is there a motion to approve? Don't be shy.
I'll move to approve.
Thank you, Councilmember Baxter. Is there a second?
Second.
Thank you, Director George. Now, are there any questions about the transfer letter? July through September is anticipated to be $180,000. Any questions? All right. Now, if you all can unmute yourselves when we vote, please. All those in favor of approval, say aye. Aye.
Aye.
Anyone opposed? Okay, that motion passes. Now, on page 5 is for your information only. Brenda Wright passed on January 23rd, 2024. She was the widow of Clark Wright, and there are no benefits due, but this is for your information. And Ella Beckham passed on April 17th, 2024, widow of William Beckham. And this is also for information only. Neither of them had benefits due. And so we certainly remember them as well as their spouse's service to our city. And then number 5 on the agenda is the discussion of whether to increase the benefits to retirees and beneficiaries. And we had a little bit of that. This is on the agenda because we had a little bit of that discussion of perhaps wanting to do this. So we have the ordinance on page 6 and the history of annuity increases on page 7. So I'll just kind of open up the discussion for this to get your all's thoughts about whether we want to do this. And you can see that history. I appreciate you all getting this information for the packet. So we know that if we do this, we don't want to do a supplement, because what happened when we did that was it actually was not totally helpful to our beneficiaries and retirees because it impacted their Social Security. So we learned from that we went back and did the percentages to the base amount of the benefit. So what sorts of comments do you have? Do you want to do this? Yes, Councilmember Baxter.
So just confirming, the supplement is the only thing that could affect Social Security benefits. If we do a percentage increase, that's not this, that is prevents that. Is that correct?
I believe that is correct.
Okay.
Aaron or Commissioner
Yeah.
Hensley, does that your
Yeah,
take on
I
that?
think what we found was the one-time spiking of payment was what impacted those Social Security benefits negatively, and that the prolong or the continued increase when we raised the benefit permanently did not have a negative impact.
And you can see at the bottom of page 7, these 2020, 2022, 2023, and 2024, all of those years, we did a percentage. And if I recall, Commissioner, they all were equal to the percentage that we gave our non-sworn employees. Is that correct?
Yes, ma'am. For the last several years, we've tried to mirror the increase matching our non-sworn members.
Mm-hmm.
So that would be a 3%, which exceeds the CPI of 2.6 currently, if we were to continue that trend.
Mm-hmm. And in the past, we have, remind me, those all started on January 1st of the year after we vote for it, correct? Was there a reason for the January 1st date? Does anybody know?
Susan may be able to remind us.
I believe it's because just because of the new calendar year, because everybody's COLAs come in different months. So
Okay.
we did the raise January 1st, and then anybody getting raises January through the remainder of the year got their continued 3% raise.
Okay, that makes sense, doesn't it? Okay. Other thoughts? Questions? Motions?
So we've mirrored the city's raises, and this year it's a 3% raise, which this motion has a 5% raise. So what are we thinking?
Now, which motion is that?
I'm looking at the ordinance.
I mean,
So
Oh,
that
do we have,
one,
so we're saying we want to do 3%.
that's last year's.
That's last year's. I'm sorry.
Mhm. That's okay. It is a little confusing because it says 2024,
It
but it
does.
was, yeah. So this one would, if we do the 3% to follow what the city's doing, the ordinance would be a 2024 ordinance taking effect January 1st, 2025.
Gotcha.
Okay. All right. It is a little, it's interesting. Would anyone like to make a motion?
Sure. I'll make a motion to increase pension benefits by 3% effective January 1st, 2025.
Okay. Is there a second?
second.
I'm sorry, was that you, Commissioner?
Yes, ma'am.
I heard you, but I didn't see whose lips were moving. Okay, so the motion is to increase the base amount of the pension benefit on January 1st, 2025 by 3%, and Director George has a question or comment.
I do
Welcome.
have a question. Thank you. In the previous years, did we do additional raises for employees other than just the one?
You're thinking of the year we did 3% in July and then 3% in January?
Maybe
Is that,
it.
but I don't
So
remember, Commissioner, what year was that?
I think that was between 22 and 23. So we may have actually known that and split the difference in those
Mm-hmm.
years.
Mm-hmm.
We did end up with a 3 and a 3 at some point, and I see that we had a 5 and a 4 on the 22 and the 23. So we somehow may have been in there, but we can go back and try to kind of pull that together and see.
and that's my only question. If we're saying that we are mirroring what we've done for our employees, is this consistent with what we did when we did some split? We did half year increases.
On the whole, if I look
Mhm.
over that period, it looks to be if we do the 3% with the 3% we have now, I believe that we are right on, but I can double check on that. So I
Now,
think the timelines may not have quite lined up just right, but I think we're on the whole pretty darn close to the same.
So our
Okay, thank you.
employees, yeah, thank you for bringing that up. Our employees, July the 1st, their raise took effect, correct?
Right.
So for 3%. So is the question whether we would come back later if there were the same situation as, or what is your question?
My question is, do these accurately mirror what we've done for our employees? Because I'm just going off memory, and that's why I was asking the question. Because I remember when I came back in, I guess that would have been January of 23. Employees were getting a raise in January, and they had gotten one in July of the previous year. So is that reflected in this schedule of what we're doing for the retirees? I guess that's my question, if that makes sense.
Yes, it does make sense. And if I recall, it was 3 and 3, wasn't it? So the 3, and we did it retroactive. So it became 6%, correct? Maybe you can, maybe we can, that needs to be.
I have that in my files here, Mayor. I'll try and pull that together as we're continuing this meeting and see if I can whip that up real quick, because I know I have that relatively handy. And I'll make sure that we're close before we get through the end of this meeting. So if we need to make an adjustment, we can do that.
That's great. Thank you for bringing that up, Director George, because we do want these reflected accurately. They do cite the ordinances. Now, in terms of the motion on the floor, to give a 3% base raise to the pension, this wouldn't affect that motion, correct? Because that mirrors the 3% that our non-sworn got starting July 1st.
I think maybe Director George was wanting to confirm that we were on par with the other members. So if we were not the same, maybe she would have a different motion, if I'm maybe reading her mind correctly.
You're doing it absolutely correct.
Okay.
Okay.
So if it's not, we may need to make an adjustment, and it might need to be more than 3%. Is what I'm concerned about.
So then that would take us out of the realm of, we wouldn't be basing it on what our employees are receiving this year. Is that where you're going?
Yes, ma'am. I'm thinking we might need to make an adjustment if the previous years haven't mirrored what we did for our employees, if that's the schedule of how we've been doing it.
Okay.
Mayor, would it be helpful for us just to table this motion until the end of the meeting so Commissioner Hensley could gather the correct information and then we can just vote once?
I think that would be fine. I do have it is a sort of a tricky question because the idea is to mirror. We may have gone 1 year and didn't mirror. The idea is to mirror the employee raise, not to necessarily to go back. And I could be all off on that. Yes.
Do I remember
Councilmember
correctly
Baxter.
that at some point we went back like a second time and added more? I'm trying to think. I feel like we did that at least 1 year. We added a little bit and it wasn't the supplement. And I don't know when we had that conversation.
We did a 3% on July 1st, and then we did a 3% that would take effect on January 1st of whatever year that was. And if I recall, we made the second 3% retroactive. Is that what anybody else remembers? So in essence, our employees got a 6%. So I think what you're talking about, Director George, is going back and making up for a 6% raise 1 year. Is that what you're talking about?
Potentially, maybe this year they don't get 3%, they get 4% because on the year that they should have gotten 6%, it says 5. You know what I mean?
But this is every year we decide whether to do this or not. So it's not it's not by policy that we're doing it, right? I mean, I think this board hasn't discussed making it our policy to do this every year. We do it year by year. Am I making sense?
Yeah, and the only thing that triggered it in my mind is because it said we do the across the board for what we do for our employees. And then when I was looking at the percentages and the ordinance, I thought maybe a couple of years we did something different than what shows here.
Yeah, but it's not our
and
policy.
That's the only reason I asked the question.
Yeah.
Yes, ma'am.
Yes, I understand what you're saying. It's just we've never made a policy that this is automatic. We do this every year. It is discretionary, right? And Samantha's going to weigh in and she'll have the perfect answer.
And I guess it's discretionary and we don't have to mirror what the employees are doing. So if we wanted to do a 3% this year, that's fine. I was just asking a question. Does that make sense? So we can set it as whatever we want it to be.
Yeah, absolutely. And I think you're right. This needs to be reflected in the document. And now Samantha knows the answer.
I don't know about that, but I did want to chime in that back, I think it was in, I don't recall if it was 2019. We didn't really meet in 2020 or 21, but the board had talked about dispersing the funds, since it was so overfunded, to the retirees on an annual basis. That's why it was requested to be on the agenda every year for the board to decide if they wanted to do it or not, because it was their money. And I think there was a discussion when I was looking through some of the minutes about why the police and fire pension fund didn't disperse certain increases. It used to use the CPI, and I'm not entirely sure about that, but they wanted to, there was a discussion to cut the difference matching the employee and being above CPI. And I don't know how well that stands. I'm not up to date on all that information, but in the previous years when this was kind of like, let's put this on our radar annually.
Yeah.
Those were some of the discussions.
Exactly, because the pension is it's overfunded, right?
Yeah.
And so I remember that discussion because we decided we wanted our beneficiaries to be the recipients of, many of them are on pensions that were determined in 1970s, right? Or 80s. So, and the supplements, I don't think the supplements, followed what Urban County government did. Does anybody remember? Well, anyway, so back to Councilmember Baxter's question, should we table this to the end of the meeting? I think that's fine if you want to make a motion to do that, or if you want to go ahead with the motion that's on the floor to give the 3% starting January 1st.
Let's just, I'll make a motion to table this current motion to the end of our agenda.
Okay,
So
is there a
moved.
second? All right. That is not debatable. So all those in favor, please say aye and raise your hand. Aye. Anybody opposed? Okay, that motion passes. Now, we are pleased to have David Calvert and Allison Corbally with us to do our investment review for the previous quarter. So David, Allison, I'll turn this over to you.
Thank you very much, Mayor. I'm going to share my screen so you can see the presentation. Hopefully you also received a copy of it yesterday as well from my email account. And if I could do this correctly to make it a full screen. Perfect. So starting off at the portfolio level, as of June 30th, the combined return-seeking portfolio and the liability-defeasing portfolio totals $35,493,808. One of the notable changes you're going to see is with the liability-defeasing portfolio. That portfolio declined in value, and that was because of a transfer that occurred during the quarter. On June 20th, given your approval at the special meeting, $2.14 million was transferred from the fixed income liability defeasing portfolio over into the return seeking portfolio that has a concentration in stocks and equities. Overall, the combined allocation, as you can see in the pie chart on the lower left-hand corner, the liability defeasing portfolio represents about 15% of the overall pension fund. And essentially, that $5.3 million is expected to meet all expected pension benefits for the life of the pension. And the remainder is essentially the excess that will eventually be turned over to the city. This is just a recap of a slide that you've seen before. Every year, as of June 30th, we receive an actuary valuation. As of June 30th of 2023, you can see that the pension fund was 578% overfunded compared to your projected liabilities. During the quarter, the return-seeking portfolio generated a change in market value of $348,000, which was a total return of 1.22%. This was slightly behind the benchmark of 1.52%. So it was essentially a choppy quarter with muted returns for the period. The liability defeasing portfolio increased in market value by about $48,893,000. And there was, in addition to the $2.14 million of transfers, benefit payments of $319,078 were made. The total return for the period was plus 77 basis points. During the second quarter, there was just one tactical change that occurred. We reduced the allocation to international small cap equities and removed the emerging markets allocation ex-China in favor of just broad emerging markets that includes China. Over the last 12 months, the return-seeking portfolio had a great year. You can see that the 12-month return was up 12.09%, so an increase in market value of a little bit more than $3 million. And the liability defeasing portfolio
Am I frozen or is David?
I think David is frozen.
Okay, he'll need to get out and get back in probably, huh? Don't you just hate this?
I do think it's interesting that we all just pause for a second going, is it me?
Well, I never
And then
know
everybody
until-
kind of leans forward like, nope, nope, okay, I see movement.
So, Allison, are you able to text David?
I'm teamsing him right now.
Okay, he gave us the good news and then got out.
If not, I'll skip ahead to the return seeking portfolio. And then why don't we do that? Let's see. I've got to unshare him. So let me see if I can do that. Just give me a minute. I'm gonna
No
pull up the
worries.
presentation and see if I can know if I can do that. Let's see.
This is one reason we love in person.
See if I can undo him. Okay, let me see if this works. Does anyone see the cover sheet, Lexington Fayette?
Yes.
Oh, perfect. Okay. So hopefully Dave will jump back in. Let's see, I'm gonna do a full screen. Okay. Okay, I'm going to move ahead to the markets for the return seeking portfolio, and then we'll have Dave come back and talk about the liability defeasing portfolio and some of the economic factors in our landscape of investing, just to give you a sense of how we're positioning the portfolio and movements in the market, if that works with everybody.
I think that's perfect. Thank you.
Okay. So let me ask you to, I'm going to go to page 14. I'm going to start on the equity markets here. So what we're looking at is the year-to-date return in the S&P 500 and the S&P 500 equal weight. And we've talked about the difference between the two. The yellow line represents the 500 companies in the S&P 500, all at equal weight. And then we're looking at the and then at the navy blue line, which is just the market cap of the S&P 500. And when we've talked about the Magnificent Seven are really driving those market returns over the year to date, and really significant, and it's making up the majority of the return of the S&P 500. So while we're looking at US large cap returning really well, it's really been driven by the top 5 names in the Magnificent Seven. And if you look at every equal weighted S&P 500 constituent in the broad market, it's returned 5%. Respectable, but not at double digits as we're seeing year to date. So what we talk about is a very, very narrow market that we're looking at. Let me see. I'm going to go back to this page first before I was talking about the S&P 500. So the question is, can this continue? Can we see the S&P 500, be it this Magnificent Seven, these large cap securities really driving the marketplace? Will it continue into the calendar year ending 2024 and then into 2025? Well, if you look at sectors in the S&P 500, in and of itself, there are 11 sectors. More than half of those sectors are projecting year over year increased earnings. So positive earnings outlook, positive revenue outlook. And yes, we know that the sectors that were in the Magnificent Seven, communication services, IT, yes, lion's share of the outperformance, anticipating moving forward, continuing to drive the market, but we are seeing more of an opportunity for the broader market to continue in the market trajectory. Moving forward. Now, if someone were to say, well, how does this really measure towards the tech bubble in 90? Well, it really shows that these particular companies in the S&P 500 majority have really attractive revenues, strong earnings growth, and really stable balance sheets. So it's really so much of a different environment than we're looking at when we look back at times where the market really did have somewhat of a significant correction. So looking at the broad market moving forward is anticipating that S&P 500 large caps will continue to carry the market and do well. So if we look back at how the market did, and it continues, I think it's like a repeat of what we talked about in the first quarter, which is a repeat of what we talked about in the fourth quarter, which was the large cap S&P 500 driving the market. Their year-to-date return of 15.3%, as we see here. Again, it's very narrowly concentrated in the Magnificent Seven. You compare that to your Russell 2000. So your Russell 2000 is your small cap stocks. Well, we know that small cap doesn't perform well in a higher interest rate environment. They carry more debt on their balance sheet, so they are probably paying higher interest rates. The fundamentals look good for S&P 500, but not favoring this market environment right now. And if you look back at the difference between the year-to-date return of large cap S&P 500 and the Russell 2000, over significant hundreds of basis points, we haven't seen this dispersion since 1978. So again, if you strip out the Magnificent Seven, I think looking at a more respectable return would be more in line. But again, very narrow market. Outside the US, looking at international equity, they're broadly flat across the market. Your ACWI ex-US is your all international. Your EFI represents just your developed markets and your emerging markets. ACWI ex-US, if you weren't aware, includes EFI plus emerging markets. That's really predominantly what it includes. So you see the 5% return on emerging markets. We talked about China's woes in the past quarter. The portfolio did have an emerging market China X exposure. Dave mentioned that we removed that from the portfolio in May. And why we did that is because we did see that the Chinese were Chinese authorities were supporting the environment by taking friendly actions into supporting what they were having issues in the real estate sector, which has really helped, but they'll continue to have to be on top of it, really to support China moving forward. So we don't think China is out of the woods at this point, but we are back to market exposure for emerging markets for the portfolio. And I know Dave is going to speak more about the fixed income. Fixed income assets posted generally flat returns amid a modest uptick in interest rates. And you know that where you can see value, particularly in the fixed income space, is in the high yield, where you can generate a higher return with more riskier assets. So before I move on to the positioning of the portfolio, Dave, are you back by chance? Because I can't see because I have the presentation on my screen.
I don't see him.
Okay.
So,
all right. So I'm gonna move ahead if you don't mind.
That's fine.
So let me talk a little bit about the factors that we're looking at, which have not changed significantly from last quarter, except we're looking at inflation. We've heard the Fed talking about inflation numbers coming down. That's what we want to see, more stabilizing economy. more confident in where this market, where the economy is moving forward. We are seeing progress on inflation. Again, we are very data driven, waiting for new numbers to come out. We know that we have not had an interest rate cut this year, beginning of the year, 4 to 6. We maybe talked about in first quarter, maybe 2 to 3. I think maybe one. One area that really is around that is that we are coming into an election year. With an election year comes more volatility in the market. Fed may not want to show positioning one way or the other. They should be agnostic as far as parties. But it may not play favor one way or the other if they take a position in this market by cutting rates. But there needs to be more conviction in order for the Fed to cut rates. Remember, the Fed's job is unemployment and steady inflation. Those are their two caveats that they focus on, that we have steady level of employment and low inflation in the US economy. We need to see the labor markets make that adjustment. We have seen the unemployment numbers coming in, and I say better because they're a little bit higher. We did start the quarter with one person looking, there are 1.3 jobs for every person. Oh, here he comes. I need to admit him. Hold on a second. Let's see if I can someone see him on the screen asking to be admitted?
I'm on.
Oh, there you go. Thanks, Dave. So Dave, I'm gonna send it back to you because I've got my share screen so I can drive it. So perfect. I was just talking about the labor markets, and then I'll kick it back to you because you're going to talk a lot about from the fixed income side and the economy side, some of these moving factors. Sure. And you've got some great charts. But just wrapping it up on the labor side, and I know Dave will come back to it. We're now looking at one person looking for 1.1 jobs. We're still at a better level than we were pre-pandemic for the labor market. But if you know, we don't have as many people participating in the labor market as we did over a year and a half ago. So we have to take that into consideration. But again, moving in the right direction. I'm going to stop there, Dave, and I'm going to move it back to where you left off. Here?
Sure.
Okay.
Did you cover all these the slides? So
the only slides I covered, I started talking about the S&P 500 and I did a review of the markets.
Okay, very good. So as you can see, here are the historical returns. These are annualized total returns for the total fund. So this is the return-seeking portfolio. You can see over the course of the last 12 months, the fund generated a return of 12.09%. Over the last 2 years, an annualized return of 10.05%. And then you can see in 2021, where it's like it was a rough year, that kind of dragged down those overall returns. But 3-year returns and 5-year returns are above definitely long-term fixed income averages. So go to the next slide. So overall, the economy is in healthy shape here in the United States. We just received the second quarter GDP report and showed the economy growing at 2.8%. This compares to 1.4% for the first quarter. For the economy, the size of the United States, growth in the 2 to 3% is basically potential. This is actually very strong growth, and that's why we continue to see strength in the stock market, and that there continues to be billions of earnings momentum for a lot of different companies. All eyes for the rest of the year is going to be on the Federal Reserve. The Federal Reserve has been on hold for about 12 months, and they've kept the federal funds target rate in a range of 5.25% to 5.5%. This rate is essentially the highest that we've seen in 24 years. You have to go back to the early 2000s before we've seen a rate that was higher than what we currently are experiencing right now. So there is actually a Federal Reserve meeting tomorrow, and it actually starts today and it concludes tomorrow with a decision made by about 2 p.m. Where most economists are expecting no rate change. However, everyone's gearing up for a potential rate cut at the next meeting, which is going to be decided on September 18th. And after that, there's another meeting right after the presidential election on November 7th. And then the final one for the year is December 18th. Over the course of the last 6 months, the markets have basically went from that the Federal Reserve might cut rates by 6 times to just maybe 1 cut. And now we're in the 2 to 3 cut camp. So there has been a lot of volatility. And why you've experienced and seen a sharp uptick in the stock market over the last 3 weeks or so is that there is growing evidence that the Federal Reserve will cut rates sometime in 2024. And that has essentially caused a lot of volatility in the fixed income markets as that information is being digested. On the next slide. One of the things that's actually helping the market and calm concerns is more stability in the labor market. Over the last 3 months, you saw job creation of 532,000. We had 108,000 jobs being created in April, 218,000 in May, and then 206,000 in June. Compare that to the prior 6 months, you can see it's slightly slower, but that's actually a good thing for the economy because too much job creation is actually creating labor inflation. And that is one of the things that the Federal Reserve is concerned about, because if there's too many jobs but not enough laborers, then it's like workers can demand higher and higher compensation in terms of salaries and bonuses. We actually saw a slight uptick in the unemployment rate. It increased to 4.1% in June. And all this has been viewed positively by the stock market and the fixed income market in favor of, okay, lower rates in the future, as well as greater profits for corporations. Next slide. So everyone's concerned about inflation, and I think over the next 3 months, you're probably going to hear about inflation quite a bit. In 2022, inflation was definitely above average and almost kind of like out of control. And the Federal Reserve clamped down by raising rates extremely aggressively. The U.S. Consumer Price Index is now increasing at a rate of 3% year over year. That compares to 9.1% during the middle of 2022. And I found the chart on the right-hand side to be extremely valuable. It's like, what areas of the market are we seeing price increases? If you looked at your auto insurance bill lately, it's kind of like a little scary. It's like I was just kind of like shocked. And this is reinforced with the chart on the right-hand side. Over the last 12 months, auto insurance has increased by 19.5%. So when you get your semi-annual premiums that most people are receiving, you would see probably a very much higher rate. And that's partly because I found like some industry statistics that one, it's like that there are more accidents that are occurring. And then two, those repairs when there's an accident are much more expensive. If you think about it, if you got just bumped in the rear of your car, there may be 3 or 4 different electronic sensors that have to be replaced in order to make that repair. So repairs are much more costly. And the markets have been kind of adjusting from the period of time where it's like no one was driving during COVID. So inflation is actually coming down in the United States, but it's also coming down all across the world, which is the bottom left-hand chart, which is the Eurozone Consumer Price Index. And you can see it essentially mirrors here in the United States. Next slide. So we talked about the Federal Reserve policy. This is what the Federal Reserve has telegraphed at its last FOMC in June. They make these predictions every 3 months, so every quarter, so June, September, December, and March. At the meetings like tomorrow, they're a lot more silent. It's like they release their press release as well as having a press conference, but they don't provide the summary of economic projections as well as their projected dot plot. Next slide. And I think you covered all
these slides.
Great. Okay. I'll let you finish up the presentation now.
Any questions for Dave on the economy before we move to the portfolio?
Thanks, Dave.
So can everyone hear me? Okay. Taking into consideration what Dave has talked about with the economy and how we're positioning the portfolio as it relates to the major asset classes, what we're hearing is that the economic landscape globally is in decent. We're seeing earnings growth remain largely constructive, and also we have in the equity markets a period of low volatility, some volatility in the fixed income space. How we've positioned the portfolio hasn't changed in the last quarter. We're staying neutral, strategic to the benchmark. And the reason behind this is because really of the uncertainty around the corner. We have coming up, as Dave mentioned, we have an election coming in November, which will increase the volatility of the marketplace. We're still data driven on, we are anticipating there will be a cut in rates, but when that will occur. And then in addition to that, we do see valuations on the equity. Obviously, we've seen the significant, growth and return in the S&P 500, and the valuations are a bit stretched in the U.S. equity marketplace. So we're remaining neutral in the U.S. as well as in the non-U.S. equity space in the portfolio. And then the fixed income would be the same story, with the exception of having that exposure to high yield in the portfolio to add some alpha to the return. So if we look at the performance for the through the second quarter, 2024, for the return-seeking portfolio, up for the quarter about 1.2, trailing the benchmark about 30 basis points. Year to date, we're in line with the benchmark. This is a 60% equity, 40% fixed income portfolio, up about 6.2, matching the benchmark, up about 6.2. Portfolio with respect to U.S. equity, predominantly that first line showing Schwab U.S. large cap, predominantly we're passive in the portfolio. Why? Because of the valuations, because of the anticipated increased volatility. And if you go down that particular segment on under domestic equity and you look at a specific active manager, Von Nelson Select, their returns were not in line with the market. They returned a negative 2.76 versus the benchmark of 3.22. So let me share with you that it's really not a great return, but what you're looking at here is active managers looking to find value in the marketplace. And really the only way that they're going to outperform the index is if they overweight the Magnificent Seven. I mean, significantly overweight the Magnificent Seven, because you're talking about 4 to 7 large cap companies that performed exceptionally well over the rest of the constituents in the S&P 500, which we showed earlier, showed single digit returns. And so if you were to be an active manager overweighting those companies that perform really well, you're taking a lot of risk in that portfolio. This particular manager looks for long-standing, bottom-up fundamental companies that can continue and support earnings potential and earnings growth. So what you're finding is the active managers have been really displaced in this market. It's really difficult to compete on that benchmark. And for the international equity portfolio, we are a mix of passive and active. As mentioned earlier, we have taken off the ex-China weight in the portfolio. You do have exposure to China. You've always had exposure to China. We just had less than the market when we took on that emerging market ex-China exposure in the portfolio. And then for fixed income, your fixed income component, the whole rationale behind fixed income is really, which we obviously didn't see in 2022 because the markets moved in the same direction, is you want to counterbalance that exposure with equity. You want to preserve the capital in the portfolio. That's your safe haven. So when the equity markets are going like this, you can count on your fixed income as a steady eddy. So our role in the fixed income is we want to outperform the benchmark. Fixed income doesn't move as significantly as equities. So the differential in returns are not as significant as you'd see in active equity portfolios. And so with that flip side, if you've underperformed, it's hard to catch up to that underperformance. But the portfolio in itself, you look at the quarter return of 40 basis points, outperforming the benchmark over 35 basis points. And then if you look at that year-to-date return, January through June, positive return of 25 basis points, and that's compared to a negative 71 basis points, so almost a full 100 basis points above the benchmark. Really, that goal here is to protect and preserve those assets and to garner some return as well. So the fixed income has, I think, done its job nicely. Not passive. Majority of this exposure in your fixed income, again, is active exposure with active managers. So Dave had indicated to the committee on the inflow of the portfolio, the 2 million plus into the portfolio. You can see that here on the top line. That's not calculated in your return on investment. The return on the investment of 348 does not account for that inflow. We don't capitalize on that. The market value as the close of June was 30,214,000 and checked. It's today, as of the close of last night, it was 30 million, just shy of 30.5 million for the return seeking portfolio year to date. So again, we're moving into good equity returns for the into the July-August period, quarter to date, that is. And then lastly, you could probably mirror this from last quarter. Again, we're staying aligned with your strategic weights, a 60-40 portfolio, staying on the conservative side, comfortable with market returns, and then selecting active managers in those spaces where we believe we can add value for the portfolio. Not a lot of changes from last quarter. Let's see. We have taken off the China. We're looking at some other fixed income managers for the portfolio. For this portfolio, if we do make a decision to incorporate, you will receive a communication piece on this. I know the investment team is going through the process of evaluating and voting and having a core manager approved for the portfolio, not to replace the current manager, but to complete that diversification. So with that, let me stop there and take any questions the committee has, and really, truly, thank you for entrusting PFM to asset management to manage both of your portfolios.
Thank you, Allison. I'll open it up to questions. Who has a question? Anybody? This might be an easy crew today. Are there questions for Allison or David? Well, I see none.
Okay.
So thank you all so much. This is a great report, and I think the thing I really liked was the economic growth number that you gave us for the United States. I think that's a great indicator. The 2.8%, I think it was. So anyway, thank you so much. We really appreciate it.
Thank
Thank
you.
you.
Yeah. Now, the only item left besides looking at our meeting schedule, we have an October 29th meeting, is to bring back to the table the discussion of increasing the benefits. So could I have a motion to do that?
So moved.
Thank you, Commissioner. Thank you, Councilmember Baxter. Now, do we have, Commissioner, were you able to find any other information for us about that question?
Quickly share my screen. I think we're going to give this a shot. I
I'm
got
glad
a,
you know how to do that.
I got a new monitor and it shares funny, so we're gonna give this a shot. Maybe. See if I can do a window. How about that? There we go.
Oh,
Okay.
good.
Can you all see this
Okay.
little Excel sheet that I got going on here?
Yes.
Yes.
Okay, so our schedules don't quite align, but you can kind of see what I've been able to gain, and I was trying to get with Glenda and see if my dates match. But this is kind of how it looked. It looks like where we do the January increases for the city employee pension fund versus the fiscal year. We did have a little bit of January that crept in there for the other employees. But they are off a little bit, but you can kind of see overall they're pretty close.
So,
Over time, it looks like the major difference kind of occurred right in here in the COVID time. The increase for 2020 for city employee pension fund was approved before kind of all the COVID stuff hit. And then everybody took a breather. And then we had all the CARES items happen for the employees. And then we went back and did the retro for the active employees currently. And so that's how we did the 3% and then went back and did the retro 3%. So that kind of got adjusted. And I believe Councilmember Baxter may have mentioned in a previous note that I think we may have done something similar right in here with city employees, pension fund members, where we weren't real sure where we would land with the employees. So we did a partial, maybe did a 3% and went back and did a 2%, somewhere in there, and did something similar along the way. But where we meet quarterly, I think we knew that in advance enough to go ahead and do it roughly around the same time. So we knew roughly where we would be and tried to kind of make that. So they don't quite necessarily align year for year. But that was kind of the effort. And I think we started having those conversations because it was my second year on the board, would have been right around here in the timeline.
so,
Because I joined the city in late 2020. So
so Aaron, is this showing that basically the pension fund beneficiaries have received 21% increases in the non-sworn city 22? So
right.
almost exactly the same.
Yes, roughly.
Okay.
Yeah, we're pretty
Yeah.
close. Again, the timing's a little off and it's not quite, I think if you mathed it out, it wouldn't quite be there, but yeah, that's effectively where I was trying to get to.
I think that's a really good visual. Thank you. All right. So we have a motion on the floor to increase the base pension by 3% January 1st, 2025 for the beneficiaries so that's the motion we need to discuss unless there's some sort of an amendment. Any discussion? No? All right, well then we'll take a vote. All those in favor of increasing the pension benefit, the base benefit to our retirees and beneficiaries, please say aye. Aye.
Aye.
We've got 4 votes. Is anyone opposed? All right, that motion passes, and I really appreciate that, Aaron, that you could go back and find that.
Well, I
Very much.
appreciate Samantha documenting on the bottom our history
Yes.
for the city employee pension fund, because I would not have had that lickety split and Glenda for trying to pull together her recollection as well. So
Yeah, it's good discussion, isn't it? And I personally am very happy that we can do this for our beneficiaries because they, most of them have pensions that are very old, and we hope this will help them keep up with our economy and our expenses. So, any other comments about this? All right, very good. Okay, is there anything else for the good of the whole here? This pension increase will take effect January 1st, 2025. And I will say it's really great to have both Gay and Charlene here with us today. I think, do I sort of sense that the virtual meeting helps you all get to the meeting? Is it easier?
Yeah, it is for me, yes.
Uh-huh. Okay, very good. All right. Okay, well, if there's nothing else, I'll entertain a motion to adjourn.
So moved.
Thank you. Is there a second?
Second.
All right, all those in favor, please say aye. Aye.
Aye.
All right. We are adjourned. Thank you all very much, and we'll see you in October. Thank you.